Okay, guys, welcome to today's show. And I'm going to kick off today by putting a question out there. And that question is to really think about the most expensive decision that you've ever made. And I would presume that a lot of people will automatically then think, oh, I maybe made a bad investment, maybe a failed business, possibly overpaid for a property. Do you know, these are a lot of the responses that that type of question probably brings in. And that would probably be the wrong answer in most cases, because the most expensive decision you'll probably ever make is that decision to do nothing. And that's what leads us into what we're going to talk about today. And I've titled that "The Cost of Inaction."
Could be the decision to marry the wrong person.
Yeah, I mean, there's lots of things. but today we're going to talk about inaction. And Jim, I'm sure you've got a lot of examples and experience with inaction being such a costly mistake in business and your personal life and just lots of things.
I find it really difficult to actually come up with something that could be, because everything, the inaction and the fact that I didn't do it has led to me where I am.
Okay.
I mean, here's a really good one, and sometimes hindsight's a great thing, and it is. It usually tells that it was the right decision at the time, and it feels to me it was the right decision at the time. I went to put a deposit down on another property in Spain when I was out in my existing one on the same development, but further down, a different development, the same company in Spain where I am. And I was a resale agent at that time, and I knew the prices were going to get put up to 250,000, and they were sitting on at something like 210,000 now. And I thought, bloody hell, I'm going to make a 40,000 gain straight away.
Almost straight
when
away,
that price goes up, and me putting a deposit on at 210, or I think it was 205 or something like that. And I thought, I'm going to make 40 grand. So quickly got in touch with the solicitor and everything like that, put my deposit down to 500 euros or something like that, and proceeded the wheels to go in motion. And lo and behold, a long story short, my solicitor just delayed and delayed and delayed so much that I ended up getting to the point where I thought, don't bother. I've lost the opportunity, because they kept putting pressure on me, and I'm going to forget about it. I lost 500 euros, but subsequently the credit crunch came along and wiped everybody out.
So you could have looked at that, So you could have been thinking, God, that inaction's costed me, but then it's actually probably saved you.
At the time, that inaction cost me, but it wasn't a my inaction, it was someone else's inaction. I couldn't do anything about it. The inaction you're probably talking about is actually just doing nothing. Nothing, even though you should be doing something. And so yes, I've probably got lots and lots of historic examples of possibly maybe even doing the wrong thing, maybe even not doing the right thing. I don't know, and maybe not doing anything at all. But I kind of think it all led to where I am, so I'm quite happy.
Yeah. Well, that's the beauty of us doing these shows, because we'll talk about it today and pull for our own experiences, and hopefully by the end of the show, people watching will probably see why probably staying in your comfort zone, and that could really cost you more than any probably market crash or anything like that. Like you see, obviously the crash, then and the flip side, it did kind of save you in that way. But when you think of wealth creation and things, you don't pay for action nearly as much as you pay for the inaction or the hesitation that you have when it comes to, like for example, property investment.
Here's another example that might have come off better if I had actually waited. Could I have waited for that fixed rate deal that I got at 7.5% with the Bank of Scotland before the credit crunch? I fixed it for something like, I'm not really sure if it was 5 years or more, but I was stuck in a fixed rate deal, and I tell you what, the market crashed. Interest rates went down to 0.5% or literally zero, and I was still paying 7.5%. And I'm thinking, if I hadn't actually run into that, and I maybe would have had a bit of an inaction, then it might have been a different story. But then the reality is, would it have allowed me then to get money out to buy more property? And the answer to that is no. Because they weren't allowing you to lend. So if I actually waited for the market to crash, and then it had then crashed, then I went to try and get it refinanced, they probably would have turned me away. I could have been a casualty at that time of the market.
It's quite interesting, because I mean, as you're saying, these in real time at the time, some inactions possibly you could look at were costing you. But then when you take it for the long term, because you've had such a long journey through your wealth creation,
I'm an
you look at
accountant.
that,
I
you
can make
wouldn't,
anything
you
look
wouldn't
good.
change it because you've got to where you are. So really, everything, it's all relevant to where you are.
Yeah.
So that's the flip side of it, I suppose. Then
I'm a statistician really at heart, and I'm an analytic and numbers, and it doesn't matter what happens. I could always spin it. I should have worked for some of the political parties. I could always spin it into a good story in some shape or form. That sort of thing. It's it's that. Yeah, it is the cost of inaction, but it is the cost of action. And probably in hindsight, would you do something different? But it's the whole thing about hindsight's a great thing.
Yeah. That is. Well, we're going to move on. And we're going to talk about, do you know, that invisible bill that possibly people are paying, and there is that bill arriving at your door every single
That I would
day.
be interested in, this invisible bill, because it's like the very fact that you said it's an invisible bill suggests straight away it's something we're completely unaware of, and it costs us money every single day, or the ability to have money every single day. I'll be interested to hear this.
Yeah. So I mean, the invisible bill, and like you say, you don't see it, you don't sign for it, but you are paying for it. And that invisible bill, it's called, and it's something that you love, Jim, and it's opportunity cost. And that is the thing that, and a lot of people don't realize and don't take it into consideration. Do you know, when you start delaying investment decisions, or delaying starting that business, or delayed increasing your income, however that may be, your actions are your actions choosing a future with possibly less wealth in it. I mean, opportunity cost. We've done shows on this before, and I know it's something
when you talk about this, Richard, and when you talk about this, sorry to interrupt you, but I've got a train of thought here. When you talk about this, look at it in this principle. Instead of actually investing for your future, you end up taking that holiday you think you deserve. And that costs you your future. Can I say that again?
Yeah.
That holiday you think you deserve ends up costing you your future. Did you know the difference? And here's a compounding example. The difference between 5% and 7% after about 30 or 40 years, it means that you will only have a third of the fund you would have had at 7%.
Which is a big chunk.
A third.
Yeah.
It's like, so if you would have had 30 million at the end of it, you're only going to have 10 because of the 2% difference. Wait a minute, but surely that's not a third. But that's how it works out, because you're not compounding all the money that's been taken out, and the less that you're getting of the 2%, that's no then compounding, because you're not getting that anymore. So it's compounding less than it would have done with the extra 2%. And that's what we talk about, the invisible bill that you're possibly paying. It's, you don't see it, and you're paying for it all the time. Mental.
Yeah, and people don't maybe understand or take in the full consideration of those small actions that they're doing at the moment. Like you say, taking that holiday, think, oh, I'll just go on holiday. How it's going to have that profound knock-on effect to their wealth further down the line in the future, and possibly their retirement. And you could have had so much more if you just held back that little bit earlier.
Yeah, when you delay starting a business, here's a really good one. Delay starting a business. Okay, but do you know how many businesses have actually... most people would, when they get to a recession, wouldn't start a business. Well, basically, I started the business, and then the recession came along and almost wiped everybody out, and I still kept on.
Yeah.
Irrespective, I wasn't earning anything at all out of it. I wasn't even getting an income. I had to survive on my investments for about 6 years until I paid myself a salary.
To keep
How many
things
people
running.
would have quit by then?
A lot of people would have bowed out a lot earlier.
Quitting. It's like, I'll admit defeat when it's stupidity, but it wasn't. I knew at some point every dog has their day, and I knew I was building and building and building until a point came where we were all back on track, and I would be way ahead of everybody else in the game, because it is a game at the end of the day. It's like starting Monopoly. So you start playing Monopoly, you buy everything beforehand, and then somebody comes along and then starts playing Monopoly later on with you, with the same board. They start later on. It's like, oh, by the way, I own all the houses now. So you're paying me rent every single time.
Yeah, every time somebody lands on that.
It's a great one, eh?
Yeah.
It's like, so I would say start, but beware. I mean, I did the similarities between Brewdog and landlords, and how Brewdog failed and how landlords can fail as well. So it's probably really good to actually catch up on that one as well. it's probably important the lessons that Brewdog has actually taught us, and also will have taught other business owners, because it's not just landlords, it's other business owners, but over leverage, rapid expansion, running out of cash flow, you know, committing to huge fixed costs. And then the inaction out of that is, guess what? It's like when the time came and they had to do something about it, it's like they sat on their hands and did nothing. They didn't renegotiate leases. They didn't renegotiate their debt levels or their debt interest. They didn't do anything like that at all. They thought, oh, we'll just build ourselves out of it. But the appetite for that had actually run out, because the crowdfunding people, I was like, yeah, okay, there's only so many amount of people that could be fans, but your product life goes like that when in the beginning, and then it gets to the top, and then when it gets to the top of the product life cycle, it starts to drop unless you reinvent in some shape or form, and it will start to go up again and create another product life out of it, cycle. So that's the most. So Brewdog's a really good example about what happened and what you should have done next.
That is a really good example, and it's how a business in one industry and the mistakes that were made and the inactions, but how they could correlate to another business, like you say, landlords and the buy-to-let market. Same thing, just different. The same thing, just different businesses.
Well, isn't it? It's delay.
Yep.
It's going to cost you money. It's hesitation,
mm-hmm.
And it's it will be okay. Comfort zone.
Yeah,
it's that sort of thing. That sort of comfort zone that people get into. Now that all has a price overall, and most people never actually calculate that. That's what it is, really. It's that thing. I mean, what about if you take the two paths? If you take two paths, can you give us an example of this? Maybe two fictional people.
Yeah. So yeah, if you think about two fictional people and these two different paths, say one's James and one's Daniel, and they're 30 years old. All right, James starts investing probably consistently, not huge amounts, but he's just disciplined in doing that. Daniel, for instance, on the other hand, he says, oh, I'll start it when I earn more money, or I'll start it when the market starts to drop, or I'll start it when things feel a bit safer. 10 years down the line, James has assets that's actually working for him.
Yeah. Do you know how I have loads of people like that? It was they had started off with me over 30 years ago in property investment. I've got loads and loads of, because we've got a wee bit to talk about this. So we'll give examples. I've got lots of people that started with me in the beginning at property investment over 30 years ago. A lot of them are no longer in it today. They're no longer in that investment vehicle today. They actually sold because they thought they would get rich pickings. So what they did was they chopped down the tree that bears the fruit. They sold maybe because legislation or taxation was getting too encumbrant for them. Now, why is that? It's because they were geared wrong. They were set up wrong. They hadn't done any risk aversion. They hadn't done any risk analysis. They hadn't done any sensitivity analysis. This is all probability based, remember, sensitivity analysis, risk analysis. This is all what I was taught in statistics and risk management. So they hadn't done any of that in the beginning. So when more or less, I wouldn't even say a storm came along, when a light wind came along, or a breeze came along. It's oh my God! It's like I'm on the margin. I'm struggling. It's like this is going to get. It's the fear. The fear came in, and they built this mental monster in their mind, and it got worse overall, and they just like panicked. And immediately, it's the whole thing about what Warren Buffett is. It. He says when people are greedy, that's when you should be fearful. And when people are fearful, that's the best time to be greedy.
Yeah, that's when you should be.
Because they're offloading. And you're, I'll buy. Yeah, definitely. Yeah. Oh, market going down? Yeah, I'm buying, because it's like these are blue chip stocks. These will just recover, and the dividend will still be paid out. That's what they don't realize. It's like, a short-term dividend you'll not get, or you'll get less, but that's why it adjusts the price. And a great example, everybody hesitated when Trump opened his mouth about here's my tariffs, I'm going to put them in place. And I went, yeah, beauty. Stock market dropped to 7,800, and I went in and bought, and I told my kids, buy for your pension fund now, because that's the equities market we're in. Now, I think Ben was the only one that did it. And look, a year later it is now, and the stock market has just had gone up to 10,800. Just let me put that into perspective.
Yeah.
3,000 divided by 7,800 is a 38% increase in what you invested last year. Who gets a 38% return? Have you exercised that now? Where'd you get a 30% return in 1 year?
You don't.
I wouldn't say time the market though, because you can never time the market. History has demonstrated throughout all its time that you can't time a market. And stock picking is probably the worst thing you're going to do. Index funds is probably the one. Jack Bogle, Vanguard, he founded the Vanguard Low Cost Index Fund. Now he died in 2019 or something like that. But I tell you what, this was the guy that solved it for the small investor. Because before then, there was no such thing as a small investor. And everybody laughed at him when he said, I'm going to do an index fund. I'm going to do it low cost. And everybody just laughed at him. Now Vanguard oversees something like 3 trillion in assets. So do you think he jumped at the right time? Do you think, when you think about it, an investment strategy, but you're absolutely right. If you go back to that, the difference between James and Daniel, James was, I'm 30-year-old. Some people will even say I'm 40-year-old. Oh, I'm too late now. No, you're no. Because you'll be better off if you do it now than you were if you don't do it at all. The cost of inaction.
Yeah.
Look at the cost of inaction for me. When you think about the logic of this, the cost of inaction of not buying a Lamborghini Huracan. 20 years, I'll make 2 million. Sorry? You'll make 2 million. I thought that's not a cost, but it's opportunity cost. It's the fact that, when you look at the numbers, it's like the amount I would have to finance, the opportunity loss that I would make as a result of taking that money and putting it in and basically what an asset is depreciating, because they do depreciate cars, with respect to what you say. Then when you think about the logic of that, it's like it made absolute sense to buy another property and just make money that way. And that's probably the difference between. That's probably the difference between James and Daniel, isn't it? Daniel goes and buys the car, and James goes and buys the house and rents it.
Yeah, so like James has a working asset, and Daniel has, obviously, like you say, a depreciating asset or something that's not generating any income for him.
But he's got memories. Who gives a shit? It's like, I couldn't, what a memory of buying a depreciating asset. Oh, what's the about in it for a wee while? And I look great. Everybody else thinks you're a dick, by the way, driving about in it. So you maybe feel good about it, but the reality is, it's not. It's not you're watching too much Instagram. That's probably what I would say. So you're right. Let's go back to this thing about, yes, James gets a working asset for him. Daniel has explanations. But what's the difference in intelligence?
It wasn't intelligent, and it wasn't like people are, they're just lucky, and it's not that either. It was their decision to obviously to put things into action, and the speed of doing that and choosing the right time to actually take action. That's the difference there.
Absolutely. Could the stock market have dropped any further than 7,800? I couldn't care less, because I knew it was completely undervalued at that level anyway.
And it will eventually
and it'll recover.
Yeah.
9/11, it went down to about 4,100. Who invested at that time?
Do you know, I've seen it. There's a trailer for a show, and I've never watched it, and I can't remember what it was called. And it was the people that took the decision to, they obviously cottoned under the fact 9/11, obviously a horrible situation, but they knew this is the time to start obviously investing, because in time it will recover, and they were right.
Because the indices are usually just a reflection of people's sentiment.
Yes.
Because there's no coherent thought process from the public. It's usually consumer sentiment gets it all. I mean, the very fact that I think it was like 6 or 7% of houses were dumped on the market at the same time for sale. That's what crashed the market and crashed the house prices, and then crashed the mortgage and the bank, because they were in negative equity as a result. That's what did all that. It wasn't really the fact that it was toxic debt. It was consumer sentiment that led it, because everybody ran to the bank to take their money out.
Yeah.
If everybody had stayed put, and they'd be able to manage the situation, we wouldn't have been in that problem. But everybody panicked. Media's got a
The
lot
same
to do
thing
with
with, like, do you know, like, we look at conflict in the Middle East and things. As soon as there's a mention of that type of thing, not even the actual thing happening,
gas prices up.
ExxonMobil, Shell, do you know, all of these things, immediately you can see it happening. And that's before even anything actually happens. So, yeah.
Absolutely mental. So it does come down to psychology. It does count. It comes down to everything. I mean, wealth creation is the biggest gap is really knowledge, and it's, and like what you said, it's execution of, it's the speed that you would do it. It's just like, yeah, this is, you know, if you're sitting there and you've analysed it, you understand it, and it happens, it's like, yeah, this is a done deal. It's like there is nothing else affecting this. It's consumer sentiment and what's happened at this point in time. But it's the psychology of the inaction behind it is so I think it's so mesmerizing. I mean, why do people freeze? What is the inaction all about?
Like you're saying, obviously, it's if people are sitting there with all the facts and it all makes sense, why don't they just take action? And it's the fear. It's that fear of loss. Do you know, they have that fear, and that's where like you say, the psychology in action. Why do people fear that? And the fear of loss, you know, behavioral finance and things teaches you that losses hurt twice as much as a gain feels good, if that makes sense. So, I mean, we've covered that before. Do you know that the fear of losing, that feeling of fear of losing, is so much more hurtful to you than it is of actually making a gain, and that feeling good of making a gain. So that's why people have that fear and really freeze, as you say, totally freeze. And that was that which I've just spoke about, the fear of loss and things. It was famously explored by a psychologist, Daniel Kahneman, and it's called prospect theory. Just in case you were, just to get technical on that. So
I spoke about this yesterday. Actually, this is so important. I sat in a meeting with someone and I said, and I talked about the psychology behind the fear of loss and the fear of gain. And I actually took 40 quid in my pocket and I gave them the £40. And it says, how do you feel? And they went, oh, I feel absolutely brilliant. I feel elated. Yeah, that's great. And all the rest of it. And then I took it off them quickly. And I says, how do you feel now? Oh, I'm fuming. I says, now, the elation that you got from it and the annoyance that you got from it, what was the elation like on a 1 to 10? And they went, yeah, it was probably about a 5 or 6. And what was the annoyance like, you know, taking it away? It was probably about a 9 or a 10, almost right up there. And it's what you say, it's the we fear, the most we fear is the loss.
Yeah. That's a really good, like, real-time example that you used, obviously, with the £40. But, and it's just like the example I've put down here, and it's like I've wrote, like, the fear of losing, say, £10,000 is more than the desire of actually gaining the £10,000. So then what do? You don't play the game at all. So you save yourself from the, and that's where that fear comes from. So you save yourself from the loss.
Fear of rejection.
Yeah.
Why do people no phone people back? You know the amount of salespeople that actually don't phone a prospect back and don't follow up, and then they wonder why they're not getting the business and somebody else has got it.
Because they're the ones that picked up the phone to them or spoke to them or interacted with them.
Absolutely. But it's because they fear the rejection they're going to get. When in actual fact, if they phone back, they're more likely to get it than not get it at all. It is so amazing how people, especially salespeople, just don't get that. And it's like they shouldn't really be salespeople, to be honest. The difficulty with salespeople in the UK, for example, is salespeople tend to be what we call the yellows, which is like they're sanguines, they're upbeat, they're outgoing, they're life and soul of the party, and people love them. And they've got a wee touch of they're driven, but not too much. So they're outgoing, and that tends to be what estate agencies like. That's in here. If you go over to the US, where people are self-employed,
totally different.
It is a completely different attitude. They are reds. They are choleric, what you call them, I think it is. And they are determined. They are going to get this business come hell or high water. They are proper salespeople. They are competitive. They want to get the edge on everybody else. They want that business. And to them, it's a live or die situation. sanguine. It's like, oh, if they don't want to choose me, that's okay. It's that sort of thing. It's like, my God. It's like, and that's why in the UK, for example, we have the lowest estate agency fees in the world.
That's crazy.
Because we're just like, we're namby-pamby about how we do things. We know this, and you might find some people go, oh, well, I like that, rather than actually somebody that's forceful and pushy. You don't need to be forceful and pushy.
You just need to be direct and forthcoming, I think.
You need to be driven. You need to be driven. You need to tell the truth. You need to understand you need to constantly evolve, constantly learn, constantly get better at what you do. You need to be you need to almost want to be a craftsman or a craftsperson, woman, man, whatever. As in that field, it becomes a passion within you. And that's why you end up being the top at what you're doing. But it's the fear. It actually gets people. It's the fear of the loss and the rejection. It does it at all. Analysis paralysis. I talk about this all the time.
You do. I was just going to say, I was going to let you lead with that.
I've got somebody that still does this today, and they've never ever bought a house yet, and they've known me for 20 years, and they've always talked about investing, and they've always said, do you think? And I'm going, yep, you should invest. And over the last 20 years, they've never bought anything. And it's because they analyze everything. They ask too many questions. They don't make a decision. They watch too many podcasts. They get too many conflicting opinions. They watch too many YouTube videos. And it's not because you're not really stuck because you don't know enough. You're stuck because you haven't made any decision.
Yeah, analysis paralysis is like, it's so good to have a lot of information and it's so good to ask questions, but you could overdo it, and then
Have you ever heard the phrase, just shit or get off the pot?
Yeah.
That's exactly what it is to these people. Analysis paralysis. Just do it. Done is better than perfect.
Yeah. I've heard you say that a lot of times. Yeah. But the comfort thing as well. I mean, people have a kind of comfort addiction. People get so consumed by their comfort zone. It just feels so safe for them in that comfort zone. But it's so expensive. It's so financially expensive to be too comfortable. Yeah.
I feel so good. I feel so safe.
I remember years ago, Jim, and we had a conversation, and we were talking about the time, and you're like, you're too comfortable. And I remember thinking, do you know, like how you take things a wee bit, and I thought, and then, see, once you understand, I'm like, oh, you're right, I am.
And you'll be thinking, I've not got a big house, I've not got a big car or anything like that. Why am I too comfortable? It's like, no, you're too comfortable exactly where you are.
Yes,
you don't need to. This is why a lot of, and I saw it in industry, especially among the directors of companies and even the senior employees, they were encouraged to have families, to get bigger houses, to get bigger cars, and they were encouraged to do that, to amount a huge amount of debt. So then, therefore, they could never leave.
They're stuck there. Yeah,
they're stuck with the company. I know a drinks company that does that very well.
Yeah,
pays people an absolute fortune to be on their line and just do general maintenance, general jobs, and you can't get that anywhere else without some level of skill in that field that you're going to go to. So you can't get out of it. You're stuck there for the rest of your life.
And they all drive Mercedes, and they all live in big detached villas.
And they all go on expensive holidays. And I'll be honest, they maybe love it. But when it comes to weathering a storm, anything goes wrong, it's like, or you get paid off, it's like, holy shit, now you're in it.
Yeah. And the thing, to come back to like comfort zones, and the thing about being comfortable, it's so easy to remain there for such a long time. But while you're sitting in that comfort zone, do you know, inflation's moving, the market's moving,
going up.
Other people are moving on, while you're just standing still, basically. And that's the price you'll pay.
Yeah, investing definitely rewards motion, but it also rewards, sometimes just being bored. It's like, don't touch it, because it'll all work out. It's a long-term plan. So when I invested in property, when I first started out, do you think I thought, I can maybe sell these in 10 years? Somebody actually said to me the other day, it's like, because I'm obviously 59, I know I don't look at. Somebody says to me the other day, he said, I made a comment about something about, should you exit, should you double down, or should you review as a landlord at this point in time? Here's what you should be doing if you're in these positions. And he said, and the person actually commented on my timeline and said, you'll be selling up soon and retiring, won't you?
Obviously, don't know you then.
I retired 20 odd years ago.
Yeah.
And I've got no
from your 9 to 5.
at all. I've got no plans to sell at all. And this will all be passed on to the next generation because I don't need it. I get an income out of it, but I don't need the assets that produce the income. The assets are there to produce the income for me, but I don't need that. I don't need the assets, so I can pass it on to the next generation, and then they could get the income from the assets. That's what investing is all about. That is the capital it rewards.
Yeah, definitely. The real world examples I was going to touch on, and you already touched on about like the 2008 and things, and when we had like major market crashes and things like 2008, 2020. Do you know that?
I wish I'd dived in at Liz Truss, but I never noticed that coming in when she did that stupid budget, and everybody went, "Oh my God!" and the world panicked, and I wasn't on the ball at that point in time, and the stock market dropped quite considerably, and I thought, "God, I wish I'd jumped in at that time again." But hey ho, I've got 2 out of 3 ain't bad. I should write a song with that, shouldn't I?
It's already. But the 2020 thing, that's a good example. I mean, we spoke about 2008, but 2020 is a good example because you've got, experience, and we've got experience with your portfolio. I mean, a lot of investors panicked, and some of them stayed out, but the ones that sold up and moved, I mean, they missed that recovery, and the recovery was great.
Yeah.
I mean, look how you benefited from that because
look at the amount I bought just before the recovery.
At that time, yes.
Happy days. That wasn't the timing, to be honest. That was just like I had been sitting for quite a number of years. I mean, the last time I bought a property was probably 2010, 2011, maybe. I think that's the case. And I've been sitting on this, and obviously the equity had gone up and the loan to value had gone down considerably. And I was sitting at some like 20% loan to value. And then when that opportunity came along to buy property, and I started to look at the market, I thought, this is 20 years on, and we're almost still charging the same rents as we charged 20 years ago, if not probably a bit less. And I'm thinking, this can't be right. There has to be a correction here somewhere. And the price of the property was still really, really attractive in comparison to the rents that we're getting. And I thought, if these rents begin to go up, we're going to make a killing here. And the properties as potentially as well, because they were grossly undervalued. I mean, they were still selling probably sometimes at less than what they were 20 years ago. And I'm like, there's got to be a correction somewhere. And then that's when I realised, and that's when I started talking about online about there's a correction coming, especially when I looked along at the East Nuke and stuff like that. I thought, there's a correction coming. This makes no sense. The number of times somebody's salary to the average price of a property is grossly down in comparison. I mean, when it gets over 6, that's when you say, oh, the market could be overheating. But when it's below 6, it's like, wow, this is, there's something coming. And what sped it up really was COVID, when they started to inject all this money into the system, and we knew inflation was going to be coming next. But that was the time when I'd started buying and buying and buying, and people were panicking. And I was just going, just give me them. It was a bit like that Trading Places at the end when Eddie Murphy and Dan Aykroyd are on the trading floor going, buy, sell.
Yeah, I know. But it's true, and in these situations, the biggest market gains often then happen, in those days right after like times of the biggest drops. And if you miss out at that time, then your returns that you could have had completely collapse. And that's where inaction during fear it could be incredibly expensive.
Incredibly expensive, yeah. And that's why just now I'm sitting on things, sitting on my hands. Because it's like I have got no plans unless there's a one here or there. I think to myself, that looks good. That's an attractive proposition to do that. Unless a portfolio comes along at a real good price and it makes absolute sense, that's the only reason I'll do anything. Other than that, I can wait. I can wait because
Mhm.
it's not me it needs to wait. My kids can wait as well. Because
Yeah.
when I'm gone, they'll be doing the same.
Your strategy, Jim, and it's always if there's a good investment and the numbers work, no matter what time it is, do you know what year it is, or if it's right that time, then and you want to do it, then you'll do it.
So
Whereas,
when you
like,
look at when you look at the example of my kids, it's like
mhm,
Tony runs the fund.
yeah,
But Tony doesn't do the day-to-day stuff. She just
mhm,
oversees the numbers and makes
yeah,
sure they're right. And
yeah,
that's it. All she's doing is that now. It's you guys that run the fund, really.
mhm, yeah,
So Tony just makes sure she oversees the numbers, makes sure the numbers are right, makes sure the occupancy rates are right, and everything's back on track and everything's going as it should be going. And that's it, really. That's no hard to do. Do
and
you
it works.
think you could have a child that could do that? Because she's got another job somewhere else.
Mhm,
She works as a postie.
yeah,
And she's happy doing that, but she loves this bit.
the
It's
the
like
numbers,
it's just
like, yeah,
yeah, it's the
take
numbers. It's overseeing it. It's
take
the
that for you, yeah,
she's probably curious and fascinated at the same time about
mhm.
flipping heck. That's like she's probably dumbfounded at the fact that how the hell does this just
How
keep
did
going
this?
up?
Yeah,
And yeah, it will come down at some point in time by a shade, but who cares? If you've got a really good loan to value, so it's really low, and if you've got high margins and tolerance, then if it does come down and a storm comes along, it's like, yeah, okay, bring it on.
mhm,
It's not going to bother me because I live with well within my means. I do have some
yeah.
extravagance now, but I do.
But
Generally, day to day, I live
you've lived
within my
for a
means.
lot of years with that. Do you know that that's your way of living? Do you know you don't over exceed spending and things. So now that you're at this time in life, you do have some extravagant things you do, but it's because you've done all these years of preparing for to be able to do that.
Psychological thing, isn't it? It's like I never wanted to get to the point where I was like incapable of doing something.
Mhm.
And it's like, well, I waited far too long. It's that cost of inaction, isn't it?
Yes, and that ties in nicely. The other example about the cost of inaction was I was going to talk about hesitation. And if we take property, for example, do you know,
Hmm.
hesitating investors who hesitate when trying to build their portfolio, and it's like a lot of people, for instance, say back in 2015, they thought, oh wait, I'll just wait it out and see if prices drop, and then you know 2016 came, and then 2017 came, and before they knew it,
And
we were in
2021,
we were in 2021, and it completely exploded.
yeah.
And what did waiting cost them? It lost them a lot of equity, it lost them a lot of leverage, and it cost them all those years of appreciation and value that they could have achieved if they'd just
Yeah.
bought in 2015.
Do you know what they say now? I've missed the boat.
I missed the boat
Like,
now. And
there's
then give
another
up.
boat.
Yeah,
Hello, McFly. There's another boat. You just get on the next boat. You get on
yeah,
the next train or whatever it is you're getting the vehicle that you're wanting to use. You just start now. And investing, you know, the best time to invest was yesterday. The
not
second
now.
best time is today.
Yeah,
It's the cost of hesitation is absolutely unbelievable. It is costing you a fortune. Anybody tuning into this right now and anybody listening will have done this at some point, and you
yeah,
have nailed it on the head about the cost of inaction when it came out. Oh well, I'll wait for the house price market to dip. There's got to be a correction because they're listening to the furus, the fake
hmm
gurus out there. Oh, there's got to be. Kiyosaki's been talking about house price crash for 10 years.
yeah,
Do you know Simon Zushi? I mean, I know Simon very well, but Simon is absolutely fantastic. He's probably the best of the property trainers in the PIN network that he created.
yeah,
More admirable, I would say. But Simon even got on that train at one point in time at COVID and said the property market's going to crash, property market's going to crash. And then he had to come sheepishly on the following year and say, I'm sorry, it didn't. It
yeah.
actually rocketed.
It went in the other direction. Yeah,
Yeah, and but you know, I'll give him his full due. The fact that he's probably the only one that apologised.
I stood up.
Everybody else said
Yeah,
that.
I think I got that wrong. Yeah,
Yeah. Whereas
well,
I
you know
was
what?
sitting
I got
going,
that.
I was sitting swimming against the tide, going, I don't see the starts to thinking that to hold that up. Now I don't believe that at all. I don't think that's true.
Yeah, I think if I remember at the time, and we've probably got it on camera, that you were quite. I think this is going to go in the other direction, but you could never truly predict that, like you said earlier. But
Yeah,
if you've
and
got the
it's the
right
whole thing.
knowledge,
It's like it's for me to do that for myself. And I was saying to people, this is why I think it'll go in the other direction because of these things. And COVID, the injection of money just speeded that up. But I knew it was going to come eventually because we're even out of COVID and it's still going up.
Yeah.
But I never predicted that.
So you could that. It just shows you.
Yeah, I actually thought it was going to slow down and level out in Scotland. And it's like, it's still going like a fair.
Yeah, I'm really surprised at the market at the start of this year, to where we thought maybe it was going to head.
It's because products are becoming more creative in terms of the banks. It's because
lending
lenders become more creative. Interest rates and swap rates between banks are becoming in the money market are less. Therefore, they're predicting lower. They're maybe accepting lower margins on their tolerances. We're now seeing the introduction of 95% loan to value mortgages for first time buyers again.
Yep.
And I think we're going to get to 100% again. And I think it's all going to creep back in.
That's where 2008, that's where that happened. Yeah.
Yeah. But I don't think it'll be a 2008. I think it'll just be a like, oh my God, what have we done? And it's like, and there'll be a correction somewhere, and we'll all settle down again, and then it'll start to build momentum again. Because as soon as you start creating adding value in your economy, and as soon as you start increasing things, then obviously that added value will trickle down to the people on the front, us, the people working in these industries and these services, and we'll go and spend, which will actually start all that cycle up again. The things to watch out for now about investing, and this is not sit and do nothing. This is like just watch out for them. Unemployment's going up. Inflation will probably start going up because of the crisis in the Middle East now, and also you might find interest rates might not drop, and if they do drop, just be wary. If you're going to get a deal, I'm even thinking about just switching over and actually paying the penalty if they do drop more. Is actually fixed for a 5 year. That's what I would do to have certainty. And these are the things that I do. Interestingly enough, when you see growth targets, the UK 1.3 or 1.2 or something like that, China, oh yeah, boy, their growth has come out at under 5%. They have never had that for years. Now, I know for a fact that when China says their growth is 5% or lower, it actually means their economy is suffering. Even though we go, well, man, we'd love that growth. Not to them, it's a slowdown. When you think about the slowdown with China and the fact that their slowdown would ripple around the world, just things to be wary of. That's all.
Yeah, I mean, you spoke about unemployment. I mean, what's unemployment just now? Is it 6? It's just about 6%, isn't it?
It's 5.1 now.
5.1,
it probably will go up again. Youth unemployment's appalling. Over 1 million out of work. Approaching over 1 million, and about, I think it's about 16% or something like that. I can't remember, but I know it's appalling. Or is it 30% of youth? Something like that. It could be. But it has gone up quite considerably.
We get the picture, yeah.
You could check for yourself. You just go on Google and actually look it up. See if you get someone Google or AI, look it up, and then fact check it, please.
I'm sure it's correct, yeah.
Because it could be any idiot that said it. It's just, that's all it's doing, is bringing out together all this information for you then to make a judgment based on what it's telling you. But it could end up making things up because somebody else made it up somewhere else. Like I just said about the unemployment, about youth unemployment. I maybe got my stats wrong. I know it's just under 1 million, but I maybe got the percentage wrong, but it might actually pick up in the percentage. And then you listen to that and go, oh, well, it's only there, so that's no bad. And it's maybe no there at all, which it probably isn't.
It's not actually accurate, yeah.
So this is the compounding effect then. What happens is of action. Compounded does not only apply to money.
Okay.
Now this, for me, this is the one I learn about all the time: health, wealth, knowledge, expertise. I'm a literal sponge. I've written away actually to Richard Branson, name drop, the Now, and actually said about Necker and all the rest of it, because I got an email from them, and I was writing back about certain things, and I've talked about skills and everything like that. It says the biggest thing I learned out of Necker was actually getting around Richard and getting around Joan, and what I've learned out of that, and they're probably completely oblivious as to what they've taught me, just with being around them and how they've been. So these are things, when you think about it, the compounding doesn't apply just to money. It applies to things like skills. It applies to networks.
Well, like you say, getting around the right people and things,
Well, is it a case that most people say it's not what you know, it's
Who you know.
who you know?
But then it's what you
Absolutely.
learn from those people as well.
My first job in Fodler Balfour as a trainee accountant was because Sandy Dowie, my immediate boss, knew me, well, knew my dad, and knew I was in the local golf club.
Yeah. So it's your
It's not what you
association
know,
with
it's who
these
you know.
types your association with these types of people put you in a
Yeah.
certain, you know.
Yeah, and he knew of me because of that over the years. And George Barber, who was his boss and the financial director at the time, knew me through that process as well, or knew of me. They never knew me personally, but they knew of me. So it was like, yeah, okay, local golf club. We like the golf club. Everybody gets on well there. There's a network of people. It's like, yeah, that makes sense. This guy is a good candidate for us to take. And that's how I got my first job. It
You
took
see that a
ages
lot
to get that.
in bigger, in bigger companies and things as well. To get yourself up the ladder, it's not always what you know; it's who you know on the ladder.
It took ages to get that, Richard, and it was I had to then build. Here's another one we want to talk about: compounding reputation over time. I
Yeah.
built a reputation. It was second to none because I worked hard.
Mm-hmm. Put
Now
the
the
time.
boss, the CEO of Uber, talks about that. He says, "What would you tell your kids now about AI and all the rest of it?" He says, "I would just say work hard. They'll be
Mm-hmm.
fine." And actually, he actually recommends, and I kind of think, yeah, that's where I am now. Actually, don't really have any fixed goals as such, because of the changing environment we're in and the quick way things change. You'll probably find that you have to be quite fluid in terms of where you're going to go. So you might have a target for what you want to accumulate in terms of wealth to retire, something like that, but don't be so definitive when it comes to what it needs to be to do that, because that industry might change. I mean, 8 million Uber drivers in 20 years time will no longer be Uber drivers. It'll be AI. It'll drive it. They
That'd be
won't
the
be needed.
automated,
So where
yeah.
are they all going to go? And so that's it. So building a reputation and all the rest of it, and having the confidence to do that. Confidence was a big
Yeah.
thing for me. I was quite cocky. No surprise there. Then you would say, or anybody would say, it's like, and quite arrogant. No surprise there. Then
But I think that when you demonstrate confidence and kind of ooze that kind of cockiness, I suppose,
got to back it up though.
people. But obviously, yes. But I think if you're people then want to go in your direction and take your lead because you're so confident in whatever field it may be.
Well, put
Confidence
it
is
this
all.
way. Look at it this way. Your first investment will feel scary. So I was
Always, yeah.
terrified to get my first property, and I remember it was 176, and I looked at it and I did all my numbers and I started to get paralysis analysis. I
Hmm.
started to, but then what I did was I had been in the graduate enterprise program. I'd been taught about running businesses and stuff like that, and about doing consumer marketing. And I thought, I'm going to put an advert in the paper. I've not bought the property yet, but I'll put an advert in the paper just to see who phones. The phone rang off the hook. It was mental. It's like, oh, there's definitely a demand for this property. I
Yeah.
am buying it. This makes absolute sense. So that's why, and that sort of got me off my track. Once I'd done that, and you were getting like, oh, this works perfectly. And then the bank said, it does work perfectly, doesn't it? There's something in here. I tell you what, we'll give you a facility. And I went, yeah, that'll be great. How much? And they went, 100 grand. And I went, yeah, beauty. So by the time I got to the 10th, it actually felt perfectly normal, my 10th
Yeah.
purchase. I just went crazy. I had a street that was about 20 properties that were getting repoed because it was a street that no one else wanted to
Yeah.
be in, or no one else could afford at that time because the market had actually dropped. And I just started buying all the properties and renovating them. Now,
It's
somebody could
interesting.
say, here, Richard, you parasite. And it's like, okay, so I tell you what, I would have left them to rot then.
Hmm.
Think about the amount of properties I've actually brought into use again, the
People that
amount
have
of
been
people I've
housed.
housed, because I housed a lot of vulnerable people in the beginning.
Yeah,
I'm a sucker for a hard luck story. Trust me, I'm
I
a
know.
sucker for a hard luck story. And it cost me thousands with some of them to house them, but I made the amount to be able to cover it. So one offset the other. And I was quite happy to do that because I wasn't reliant on the income at all. I was still
Mhm.
working my job. So when I was buying all this and it was somehow it was going wrong, it was like, it doesn't matter because I've got the money to do it. I've got the money for something to go wrong. I could weather that storm.
Yeah.
I mean, you know, I'm going to say it, the 100th feels strategic. And then
Well,
after that, you kind of stop counting after 100.
it's true though, because you get to that point, it is strategic decision. Do you know, it's just it's like numbers work, let's do this, but move on. But it's interesting to hear there, and what I took for that, and I'm sure people listening or watching will feel the same, is that at that very first property, that time ago, you did have that slight, you know, hesitation, analysis paralysis type thing, and that's not in the fear, and it's a normal thing to have. It's getting past that quick enough and not letting it hold you back too much is the important thing. Did you see?
Action builds confidence. Action builds competence, I would say. Competence builds confidence, and confidence builds wealth. Here's the truth. The first steps are always the most expensive emotionally, but the most valuable financially.
Yeah, I would agree.
How do we then eliminate, when we're closing off here, how do we eliminate inaction?
Yeah, because people might think, how can I just get rid of that whole inaction thing from my process?
Well, let's make it practical.
Okay.
So what do we start with?
I think you would need to really look at reducing that decision size so it doesn't feel so overwhelming and create that fear and hesitation. Don't feel like you have to invest everything.
Like me.
Just invest something or a portion of what you have available to invest and see how that and see how that works. And then that emotion, it beats trying to be perfect and achieve perfection. At least you've got something.
I've got to say, motion beats perfection every day, and done is better than perfect. And I've got to say, on a smaller scale, in a Monopoly game, I just buy everything I can get my hands on, except the utilities and the train stations.
Yeah.
Because for me, I don't think they're a good return on investment, because you can't improve on them, you can't upgrade them like the hotels and the houses and the hotels and the other ones. And I go straight away. I go, like a bat out of hell, and I try to buy everything. And when another one, because if you land on a square in Monopoly the first time round, if somebody doesn't want to buy it, it goes up for auction with everybody else.
Yeah,
that's how the game works. So I just try to buy as much as possible, to the point where I'm almost stony broke and on the verge of destruction. But that strategy worked extremely well, the Monte Carlo bus strategy.
And you've played it out in real life as well.
I know. The reality is, we're actually telling people to take it, the cost of inaction, and you might want a risk analysis and the rest of it. But how I started out was a completely different story to a degree. But I always had my job, you see. So was I really risking anything? No,
you always had that to fall back.
Yeah, and I always knew I could sell the houses, and I always knew I had investment funds which were actually put down as security to give me 100% lending, and it was about 20% worth of that amount. So if anything happened, we would just sell the houses at 80% of the value, would lose our investments, but that would be fine. We'd still have a shirt on our back and our house and our jobs and everything. So that would be fine with me. At least I tried. That's what I was bored about.
Yeah, so although you look at it as Monte Carlo or bust, you still had a contingency, because you still had your income coming for your job.
Automatic discipline.
Okay.
Every single time. You've seen the spreadsheet. That's kind of what I used since the very beginning. I removed the emotion from the execution. Automatically did automatic transfers, automatic investing, and I still do automatic investing today for the kids. Ever since I knew they were getting an allowance, even as a child, from the government up to the lower rate threshold into their pension, they were getting an allowance that they were adding it back. I was like, "Your beauty." It's like, I'm going to do this. So we're still putting the same amount of money in. I mean, today it's a fraction in value in terms of what it used to be all these years ago, but we've still stuck to it. And I did it in Spain as well. With my property purchase in Spain, €900 every single month for 20 years. Paid off the property completely. Interest rates were a record low at that time, which was brilliant, because the capital started eating into it quite easily over that period of time. Now I've got, as far as I'm concerned, I have a good investment. I looked at flights the other day, and where I go, it would cost me 138 quid from Edinburgh to Faro and back.
And do you think in terms of that investment, do you know there may be other people that possibly bought around the same time as you that might not have as good an investment as you because they've not managed it the same as what you have.
Yeah, it's like I put everything back in, and I still do that today. Really, I just put everything back into the houses, and yeah, and it just keeps building as a fund and improving the stock. To me, the primary factor is here is the constant improvement of the stock. Because if you do the constant improvement of the stock, then you're going to get the better margins, but you're also going to get the better tenants.
Yeah, better tenants, higher rents, better.
Yeah, so and having enough money aside to do, the one-offs, like we're going to do a roof for £5,000. Somebody's not want to chip into it, but one of the person is, so I'm going to have to pay their share of the now, and it's like, yeah, go and do the roof, so we can get the property back into use.
Deal with that later, yeah.
Yeah, and yeah, we'll deal with that later. And if I don't deal with it, then fair enough. I'll never get the property back into use, and I'll lose more than £5,000 over a year anyway. So I may as well just do it and bite the bullet. And if I can get my money back, I can get my money back, my share. Who knows?
And that's
But I'm of the opinion that that's why you do what you do, and you keep money aside. Not aside as such. I know it's always coming in. Put it that way. It's always coming in. There's no way out of the number of properties I've got, everything will switch off at once.
No.
You're going to get one or two that will switch off, but you've still got probably over 100 more coming in.
But then that that
roof, I should have said that.
That roof example is it's like the opportunity cost thing. It's like, do I leave this sitting empty and dig my heels in because this other person's not going to contribute, or do I foot the bill and then get mines up and running again and creating the income? And it made sense to do it that way because you're going to.
So you have it's the automatic investing, automatic transfers, automatically taking the emotion out of the decision, and it's creating these deadlines. Wealth builders move more with timelines, not feelings. See that?
Yeah, not the emotion and feelings.
Yeah, because I know I'm going to end up double council tax if it sits empty. And it's like, that's then going to be another cost. That's an opportunity, a loss. That's double council tax is about £200 a month. That's another 2,400 a year. There's half the roof paid already.
Yeah.
When you think about the logic of that. And I'm not even taking the rent into account that I've lost, which will be about 6,000. So that means if I repair the roof, get somebody in, I'm probably getting ahead of the game and getting my payback against my return that I wouldn't have got in about less than 6 months.
Yeah, I was just going to say about
for the roof. Yeah, it's paid for it anyway. The amount of rent, because I got somebody in earlier to pay, and that paid for it. In terms of that, they didn't pay for it direct, by the way, in case the tenants associations get the pitchforks and torches out, and they're like, damn.
Yeah, but it's really redefining risk and thinking about risk in a different way, because the biggest risk isn't losing the money. It's about never allowing your money to giving it that chance to grow. Yeah.
It's a bit like an orchard. You grow look at it this way. You take ages to nurture a apple tree. An apple tree maybe will take 5 or 6 years to actually grow. I mean, I'm sure we used to get apple trees when they were young in the back garden when our previous house, when I lived with mum and dad. And I was told it takes a couple of years for it to get any fruit because you're just planting it now. And I'm like, okay. So when you think about that, look at it in terms of that, it'll take you a couple of years to get any fruit from your tree because it all goes back into it. And it looks after, the tree looks after itself in order to grow into a bigger tree to be able to establish more fruit. So when the fruit starts to come, it's like it produces fruit, but it also produces seeds, more seeds. So what do? Do you go and eat the fruit and throw away the seeds, or do you go and just plant the fruit again and actually grow more trees? Yeah, which will take another 5 years to come to fruition, anything at all. And the answer to me is yes, absolutely you do. And then some of them will die, some of them will not make it, and all the rest of it. And eventually it grows and grows and grows and multiplies and multiplies and multiplies. And the next minute you've got an orchard. And it's like, then you go, I tell you what, we'll stop doing that strategy and we'll just let the income come in. Then you realise what you've built. I did that. I actually was investing all that time, and then I stopped growing for a while and just sat. And went and I thought, and I looked at it and I thought, holy shit, look what I've just built from nothing. I could not believe that.
It's like you all of a sudden take a step back and think, God.
Cha-ching,
This is what-
cha-ching, 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 cha-ching. I was like, my God, and I'm not doing anything for it now. I did all the hard work in the beginning.
You've done it
It's like
already.
writing a book as an author. You write the book and you promote it and all the rest of it. Everybody buys it, and then all of a sudden it all takes off and everybody wants to have it, and you're on everybody's podcast and everybody then buys your book again. And it's like, and you've like, I only wrote this once.
Mhm.
A song, you know, it goes on forever. Royalties.
Yeah.
That's effectively what it's like. And anybody out there that says passive income doesn't exist, it does.
Yeah.
And I know how.
Yeah.
You don't know what you don't know, do you?
You don't. And I think that a
And
lot
that's
of people
what they don't know.
know.
Passive
Yeah.
income does exist.
Yeah. And because they've probably not seen it work out, possibly for them or others, they don't understand that that's how it does work. Yeah.
This is why I refer to what we've got as a family fund.
Mm-hmm.
Because it's just like an index fund. You're not actually doing anything. Somebody else is managing it all, and you're getting the income from it and the appreciation and the value. That's it. Family fund. Woohoo.
Yeah. Yeah. Now let's round up about inaction and you know, that fear and that hesitation and leave today.
Can I do the roundup?
You round us up then, Jim. Go then.
Yeah, I'll round this up because I tell you what. Let me leave you with this.
Okay.
5 years from now, you'll either be grateful you started today, or you'll have the regret of wishing it you had. Inaction feels safe in this moment because of what's going on, but it compounds regret, I'll tell you. If you don't do what you're doing now, wait till you get the invoice from regret. It's a hell of a lot bigger.
Yeah.
Action feels uncomfortable, definitely in the moment. It did for me. But it compounds wealth over time if you take action. Beware though, it can compound stupidity as well. You can think you're invincible. I have done it and lost $1 million. Yes, I have done it and lost $1 million. Stupidity. But it compounds wealth, as I said. So you don't need certainty. You do need commitment though. Commitment to see it through overall. Because the cost of inaction, I would say, and is the life you could have built as well. I mean, what life could you have built? I mean, this is your move to make. Make it count.
Yeah.
Because you're not coming back.
To get a second chance or a rerun.
There's no second chance. There's no repeat. I mean, if you found this valuable, share it with someone who needs to hear it. Definitely. And we'll see you in the next episode.
Yeah. Good. Brilliant, Jim. Thanks for that. Yeah. The cost of inaction, hopefully we've covered that in quite a lot of depth, and the examples from you, Jim, have been brilliant. So hopefully that was helpful to everyone, and we'll catch you on the next show as usual, and we'll see everybody then.
Bye for now.
Thanks, Jim. See you later.